I'm sure you've heard a lot about the war that's unfolding in Iran. What you probably haven't heard very much about is how that's going to affect us here domestically, specifically with the California housing industry. And that's what I want to dive into here today. I'm going to make the argument that not only will it impact us, but it's going to impact us in a negative way. We're going to get into some of that data here. So the four questions that we want to answer is in regards to whether or not the Iran war is going to impact the California housing market is, so the four questions we want to take a look at is number one, will it impact us? Number two, if so, why? Number three, if so, how? And number four, will it impact me personally? This one will leave a little bit open-ended because it kind of depends on your situation that you find yourself in. The first chart I wanted to look at is taking a look at the past year's worth of data from the 30-year fixed mortgage rate here in the United States. As you look at this chart, peaked, I don't know, 8, 9, 10 months ago. Up here, when it's been a slow and steady decline up until this last little blip where it started to balloon back up. Let's take a look at one other data point here. This bottom right here on February 28th is exactly when the Iran conflict began. So if you notice a very noticeable downward trend where the prices went from almost 7% to just below 6%. And now we're climbing back up to about 6.5%. This is where we want to get into the chain reaction. So the conflict in Iran is increasing oil prices and also market uncertainty. Both of those are stoking inflation fears. That causes treasury yields to increase. Those yields are used by lenders as a benchmark to set their rates, which rise as a result. Those increased rates mean buyers can't qualify for as much house or offer as high of prices. Then fewer buyers with less purchasing power will push prices down. We're beginning to see this start to unfold now. As you get into the all-important spring season in the housing market, it has already started to impact all of us who are involved in the California housing industry and will continue to do so. So what I would say as an unequivocal answer to these first two is as to whether it will impact us, yes. Why? Number one, the biggest component for this is going to be rates. So when you look at rates, we have this thing, which I'm titling as a shrinking buyer's pool. This is the Mortgage Bankers Association data as to the amount of mortgage applications. So what you've seen again from 2024 through 2025 into 2026 is a bit of an upward trend. Most specifically over the past year, year and a half, the trend line has been going north, where it's been increasing, where a steady influx of new potential homeowners are entering the market. You're starting to see the mortgage applications rise as a result. Now let's take a look at this specific point. So the date again, February 28th is when the Iran conflict begins. And if you notice here, you have a precipitous drop in the amount of applications. So on the chart that we showed you previously, as of February 28th, as soon as that moment hit, interest rates started to rise. And as soon as that moment hit, the amount of mortgage applications started to fall. So why does this matter? The demand impact. So when you have fewer mortgage applications, that will equate to fewer buyers. When you have fewer buyers, if let's say you're selling your home, and you will have fewer offers, you will have a longer time on market. There will be more owner concessions that are being asked for. There's a higher likelihood of price cuts. And if you are in the industry as a housing unit professional like myself, that means less work for agents, less work for lenders, less work for contractors, etc. What is the impact of as rates rise, buyer applications fall? The second component of this is you have less purchasing power. So median sale price right now in the state of California is $819,000. So we're taking a look at 20% down payment, 30-year term at a 5.98% interest rate, which is where we were February 28th. That means that you'd have a mortgage payment of about $5,400. If you take these same values, but then increase the interest rate to where we are today, your mortgage payment increases by about $200. So in the course of about a month, not quite a month and a half, the average mortgage payment in this situation at least would have risen $200 from a conflict again that's 7,000 miles away. When this interest rate down here at the bottom is not set, it is not final. If this conflict continues, rates will continue to rise. Even if the uncertainty about the presence of conflict continues, interest rates will continue to rise. So the demand impact number two, buyers qualify for smaller mortgages as interest rates rise. Smaller mortgage qualifications mean that buyers will make smaller offers and or look at homes in a smaller price range. So in determining how this impacts you, especially if you're selling your home or if you're a listing agent, you have demand is going to decrease, which is going to cause supply to increase. We'll get to that in a second, which will cause prices to fall. So the double whammy of rising rates on buyers. You will have fewer buyers, which we're already seeing. You will have fewer offers, which you will see if you are listing your property or if you're an agent. The offers that you do receive will be smaller. And again, it could be because somebody's trying to bid you down, or it could be because they cannot qualify for as high of a mortgage due to the inflated interest rates. Again, longer time on market, more owner concessions being asked for, leads to a higher likelihood of price cuts, and less work for agents, lenders, contractors, all of us who are in the industry. So the inventory impact, the Iran war by itself is unlikely to create new listings directly. What I mean by this is I don't really see the correlation between a conflict happening in Iran and people being forced to sell or being even incentivized to sell. You could have some people who are foreign nationals who are saying, we want to get out of the market entirely. I don't really see that happening in mass though. So I don't think there's going to be a direct impact on inventory. However, as demand drops, inventory is likely to increase as homes sit on the market for longer. So our market is already struggling from decreased levels of activity, fewer homes being sold because demand is low. We're seeing demand drop again. And this is supposed to be a spring where some of these rumored homes that people have been waiting to sell, they got through the slow winter months. They wanted to force a sale, or at least try to force a sale in the early spring. Those might not come on market, or if they do come on market, they're going to be seeing less bites out there. So inventory is likely to build up one way or another, even if it doesn't cause an influx of new listings directly. So the standoff that this creates is that sellers do not want to lower their prices. Why would you? If you're a seller, you try to get top dollar. But if you're a buyer, you can't meet them. You just cannot meet them. If you cannot qualify for a mortgage, or if the mortgage that you can qualify for doesn't actually get you the type of home that you're looking for in the market, then you cannot make a reasonable offer. So which will break first? Historically, when affordability gets worse, prices are the first thing to break. So again, going through like a typical supply demand curve, if you have supply stay steady and demand fall off a cliff, so it means that maybe technically demand is moving first to the negative, but that'll pull prices down because there are fewer buyers out there while supply remains steady. The rumor is, and the expectation is, that supply is naturally going to increase because there are going to be some of these unburdened homes that are trying to list and finally hit the market. If you couple that rumored reality with the fact that homes are going to be sitting on the market longer, inventory is naturally going to pile up as a result of this. So these effects are likely to still impact the spring housing season if the conflict ends this week. As of the time of this recording, it has not ended. There's potentially another announcement happening tomorrow that either the conflict is over or we're bombing Iran into oblivion. I don't know what exactly is going to happen. I don't think anybody really knows at this point. But even if it were to end, quote unquote, tomorrow, the effects of the uncertainty, higher oil prices will keep interest rates higher. As interest rates stay high, buyer applications will stay low, demand will stay low, all the other knockdown effects will stay low as well. So if you'd like to join the conversation, I would love to talk with you. This is my favorite thing to talk about, is the California housing industry. So if you want to answer the question, what do you think will break first? Please comment below. If you have pushback, if you have questions, if you just want to hang out and talk a little bit and spitball some ideas, throw some comments down below. Also, we're going to be launching our newsletter pretty soon here. So first one's going to be coming out shortly. So join the newsletter for more California housing market updates. There's Nathan with the California Housing Collective. Thanks for spending the time with me. See you in the next one.